Hi, everybody. We would now like to spend some time talking about the purchase price allocation. Friends, the idea of this particular terminology, purchase price allocation, is all about understanding how much are you actually paying towards different assets and the liabilities that you're acquiring. Okay. When you do a business acquisition under a business combinations, you would acquire, let's say, running business. That's what we have been talking about. Okay. So importantly, what are the values of those assets and liabilities that you need to bring in your books and measure those assets and liabilities in that structure of the group is something which this particular section is going to refer to. Now this is certainly an important area from an examination standpoint, where we are going to discuss about the measurement of different assets and liabilities to be presented in the group financial statements. And this is something which is surely tested, from an examination standpoint, where we want to refer to the concepts of the apologies, the concepts of fair values, and then the deferred tax adjustments and related information around that. So let's start. When I say I'm looking at the when I look at the recognition of the assets and liabilities, the conditions that need to be satisfied, okay, with respect to these assets and liabilities is that the identifiable assets acquired or liabilities assumed must meet the definition with regard to the respective Ind As, right? Long time back, when we started this entire conversation, we talked about the framework. Okay, so the framework defined what could be an asset, what could be a liability, what is equity, and stuff like that. Okay, the whole context is that the acquirer should only record the assets and liabilities which are so recognized and are acquired, of course, as a part of the business combination. All right. Now, importantly, it may not be the case that what the other company is showing, right, is an asset or a liability for you, and also vice versa. Okay. It means that it could also be a case that the other company that you are acquiring, the acquiree's business, right, it may not be reflecting any elements, some assets or liabilities, but then you as an acquirer, when you are acquiring that business, for you, those elements may have some significance, or they may be relevant for the purposes of decision making of the business acquisition itself. As such, they might meet the criteria for you as an acquirer. Okay, let's try to understand that with a small example here. Think about it like this. There's a company X. It's basically an IT company. Okay. There's a company Y, which is another IT company. And this company is conducting some researches. Okay. Now they are trying to develop a software, for example, right, which they believe that eventually should be able to kind of do, should be saleable on a scale, should be sold to large set of customers, and it's workable under a scalable model. So there's a lot of value which would be attached, provided the software is developed, the manner it is intended to, right? But so far, it is under a research phase, which simply means you're charging all those costs to the statement of profit or loss, right? So the company Y will be recognizing all these expenses through the P&L, right? But the company X, those research activities, they understand well that these research activities have a considerable value to their business, right? The findings or the testing that are being done so far on that software, company X recognizes that these can be taken as it is, as a developed product. Okay. So what are we trying to bring here is that in the books of company Y, although there is an expense, which means there is no asset whatsoever. Okay. Although there's an expense in the books of company Y, in the books of company X, while it is thinking of acquiring or while it is acquiring company Y, those research which have considerable value, they are as good as an asset under development, right? And they would like to assign a value, and that's probably the reason why this company X is thinking of acquiring company Y. Okay, so when this is happening, what we observe in accounting, that this expense does not meet the recognition criteria in the books of acquiree, which is company Y in our case, right? But at the other end, in the books of the acquirer, it certainly meets that criteria to be classified as an asset. And that's probably the reason why the acquisition is even taking place, right? So in a simplistic manner, what are we trying to say is that in the books of company Y, the value of the asset may be nil because it's not even recognized as an asset. But for company X, there would be some value attached for the sake of a number. Let's say it is 100 crores. Okay. So if I really take you back on the previous discussion, we are saying that the identifiable assets acquired in the liabilities assumed must meet the definition of assets and liabilities in accordance with the respective Ind As at the acquisition date in the books of acquirer, right? And the acquirer should only record those assets and liabilities which are acquired as a part of the business combination, irrespective of the fact that the acquiree did not record any such assets or liabilities in its own books. Okay, that's one part of the conversation. The second important part of the conversation is that, say for example, in the given scenario, again, there is property that company Y owns. Okay, and let's give it a value. The carrying value of this property is, let's say, 25 crores, right? But on the date of acquisition, the fair value of this property is, let us say, 80 crore rupees. Okay, for a business acquisition decision, right? While deciding, of course, from the perspective of the acquirer, okay, while acquiring the other company, which is company Y, this 25 crores is not relevant, right? The fair value of that property would be more important. And that is where we start looking at that in the books of company Y, whereas the value of the property is 25 crores, in the books of company X, this property is worth 80 crores, right? So the two takeaways that we want to bring along is that, one, it does not matter whether that asset or liability is there in the books of the acquiree. Till the time it meets the recognition criteria for the acquirer, it will be recognized so in the books of the acquirer. And secondly, even if the item is there, even if the element of, the balance sheet, right? Maybe an asset or a liability is present in the books of the acquiree, the carrying values do not come into the picture while doing acquisition accounting. Okay, you would always take into consideration the fair value. That is something which is the underlying concept, right? We'll be discussing a lot of calculations around it to understand it in terms of what all it means, right? And that's what is mentioned here. The assets and liabilities recognized based on the aforesaid recognition principle are measured using fair value at all times, right? On the date of acquisition, we are required to measure these at the fair value. Okay. There is also a concept of non-controlling interest. Now, for non-controlling interest, we have a choice for each acquisition, or at each acquisition level, the acquirer has a choice to either use the fair value or use the proportionate share of the net assets, right? We'll be discussing that again when the calculation of goodwill, etc. comes in. But here, the larger focus is to look at recognize those items that you acquire, right? And that meet the recognition principle, right? At their fair value. That is something which is the underlying concept. Okay. It would be easier to follow if we use a small example to understand this. Let's do this together. Okay. Say, for example, there's a company X. Let's say that let's not go there in the balance sheet side of it. Let's say company X acquired 100% stake in company Y by payment of 100 crore rupees. Okay. The assets and liabilities in the books of company Y are measured at rupees 90 crore and let's say rupees 30 crore respectively. So these are the book values. The assets have a book value of 90, the liabilities have a book value of 30. So in the books, the net assets are at 60 crore rupees, right? The purchase consideration is of course 100 crore rupees here. Okay. Let us also say that the fair value of the assets is 120 crores and of liabilities is rupees 45 crores. Okay. Now, if this is what is provided, if this is the information given, how do we do the accounting under the purchase price, right? And under the purchase method or the acquisition method, right? That's something which is the expectation, right? We are saying the purchase consideration is provided at 100 crore rupees. Okay. We are also provided the net assets. For example, assets are given at a book value of 90 crores and liabilities are given at a value of 30 crores, which makes it, of course, 60 crores, right? But at the same time, there is also an adjustment that we need to do for these fair value differences, right? The point I'm trying to highlight is that the asset as shown in the books of company Y, the acquiry is 90 crores, but the real worth is 120. Okay. So that difference of 30 is not reflected in the books of company Y. However, that difference is important. When company X is acquiring stake in company Y, it does not give regard to the book value or the carrying value, but it would give regard to the fair value of that asset. So this difference of 30, which is 120 minus 90, has a relevance, has significance in terms of the decision making of the acquisition. In the same manner, the carrying value of the liability is given as 30 crore rupees, but the fair value of the liability is given at 45 crores. So even that difference of 15 is critical, right? So effectively, the net difference of 30 minus 15, which is again 15 crores, is nowhere reflected, right? But that would be important in measuring the true value of the business that is acquired by company X. The real worth of the business is essentially 120 minus 45, which is 75, right? But the books are only reflecting 90 minus 30, which is 60. So this extra 15 has to be also considered when you want to understand what is the real value of that business, right? Now, it does not mean, importantly, it does not mean that company Y has to revalue its assets or liabilities. No, we are not even saying that. Okay. What are we rather trying to say is that this 15 crore rupees differential is also considered when measuring if you are paying something extra to acquire the business or not, right? So in the given case, if you're paying 100 crores, the simple question is 100 crores against what? What is the value of the business for which you are paying 100? So in our case, it would be 60 plus 15, which is 75 crores, which means that you are paying a premium of 25 crore rupees that shall be considered or recognized in the form of goodwill. Okay, and that's the reason why. It's the reason why these fair value differences are to be considered, right? The true value of the assets at a group level from the acquirer's perspective is not 90 anymore. It has to be 120. Similarly, from the acquirer's perspective, the value of the liability is not 30. It is going to be 45. And that's how you start looking at the recognition of such items under the acquisition accounting, and the purchase price allocation is done on this basis that your assets are 90 plus 30, which is 120. Your liabilities are 30 plus 15, that makes it 45. And then you're talking about the net value of 75, and 25 goes towards the goodwill allocation, thereby making your total purchase consideration amounting to 100 crore rupees. And that's something which is purchase price allocation. Okay. That is where, and that is how you start building the thought process of purchase accounting, right? Now, importantly, and I would like you to recollect the conversations that were done when we were discussing Ind As 12 income taxes, right? We talked about the concept of deferred taxes there, right? The book base of the carrying value, a book base of or the carrying value of the asset or the liability versus the the tax base of that, right? In the same scenario, what we talked about, we are provided the carrying amount of this asset is given at 90 crores, right? Of course, in the books of company Y. Okay. But since the fair value of that asset is 120 crores. This is the resultant carrying amount in the books of acquirer, which is company X. Right? Now, what we are trying to highlight here further is that if you look at this difference of 30 crores, which is 120 minus 90, with respect to the asset to start with, right? What we want to understand, what we want to discuss is that, okay, the value or the cost of this asset from the acquirer's perspective is 120 crores. So that becomes, of course, the carrying value for, of course, company X at 120 crores. There's no problem with that. But again, we also want to understand this, that for tax purposes, right? For income tax purposes, the value that was assigned to company Y, right? The acquiree's business, that has not undergone any change whatsoever. There's no change in that value at all, which means that the carrying value has changed from 90 to 120, but the tax base is intact, which is, of course, 90 crores. Okay. So what are we trying to bring along here is that in the books of the acquirer, the carrying value of the asset or the book base of the assets is 120 crores, but the tax base is 90 crores. And since the carrying value is more than the tax base, this results into temporary differences and thereby causing or creating a deferred tax liability, right? So there's a temporary difference of 30 crores. And because the carrying value is more than the tax base, the amount that is available for deduction purposes, under taxation is less than what would be available as deduction for, for accounting purposes. That means that it results into deferred tax liability. So assuming, let's say, a tax rate of 20%, for example, right? We bring a deferred tax liability consequence of 6 crores on this number, right? The temporary difference is 30 crores. 20% of that becomes 6 crore rupees there. Okay. And similarly, we can also argue that the liability which had a carrying value of 30 crores in the books of company Y, but now has a revised carrying value of 45 crores in the books of the acquirer, which is company X. But the tax base doesn't change, which still remains 30 crores, right? So this also results into a temporary difference of 15 crores. In this case, of course, resulting into deferred tax assets to the extent of 3 crore rupees there. Okay. So having done all these calculations, what do we achieve is important, right? What we are saying here is that my goodwill calculation, my purchase price allocation would now take into consideration not just those fair value differences, of 30 and 15, but they would also take into consideration these tax implications, right? 3 and 6 crores respectively, right? So if I were to do this understanding of how did I calculate my goodwill initially without tax, if there were no taxes applicable, right? Then we said the goodwill is 25 crores. But now when I do it, of course, giving regard to the tax differences also, now we are saying that the purchase consideration is 100 crores, but you're paying 100 crores against the value of the business. In the books, it is given at 90 minus 30, which is 60 crores. But there are also fair value differences. You would recollect 30 minus 15, which makes it 15 crores, making a total of 75. But on this 15, there's a net deferred tax liability of 3. Okay, there's a net deferred tax liability of 3, thereby bringing the value of my goodwill to 28 crores now, right? My goodwill value, after taking into consideration the tax adjustments, will not be 25 anymore. It will increase because of a deferred tax consequence arising into the extent of 3 crores. It would become now 28 crores. All right. That is something that you want to consider, that you want to remember when you're looking at the purchase price allocation. Okay. So if I were to do the accounting for this, for example, let's create some space here. And see if we can do the accounting together. This particular transaction will be accounted for debit assets. So in the books of acquirer, we are talking about, of course. Debit assets, you would remember, it was 90 plus the fair value difference of 30, that makes us 120. Credit liabilities, that was 30 plus 15, which makes it 45. Credit purchase consideration, you may have issued shares, you may have paid cash, there could be a deferred consideration or a contingent consideration. We have all talked about that, which is of course 100. Okay. We also said there is a deferred tax consequence to the extent of 3. And of course, the remaining balance. This is the balancing figure, which is 28, right? And you would now recollect the reason why we were talking about going back to those exceptions of recognition of deferred tax liabilities in case of a goodwill, right? It's a similar accounting that we had done there as well, where we said that while the goodwill has a carrying value, but the tax base is 0. Okay, so there is a carrying value of 28, but the tax base is 0. Ideally, even that should attract deferred tax consequences. But no, we are not doing that, because doing that calculation or bringing that deferred tax adjustments would start inflating the goodwill, which is of course prohibited. All right. So this is something that you need to consider when you're looking at the recognition of and the measurement of goodwill and other assets, right? All these items are recognized at fair value, and fair value. Purchase consideration, the identified assets, identified liabilities, They're all measured at fair value. Of course, the tax consequences are taken on the differences, if at all, and the balancing figure, the resultant figure would be a goodwill, right? And that's what is, brought into this consideration, right? The only thing that you probably want to, take into consideration is that there could be some items which may not be meeting these criteria, right? So you would only be recognizing or measuring assets or liabilities with respect to the acquisition date of accounting. And this could be, of course, very, very different from the way the accounting is done in some other accounting standards, right? So you would recognize an asset or liabilities that would not have got recorded because of the fair value criteria. Okay. Similarly, there could be instances, the assets or liabilities may be measured at a value other than the acquisition date fair value. Very, very specific scenarios we want to now talk about, where you would start recognizing something in a different than, in a different than the usual circumstances, right? Let's talk about that. And this section is all about covering these aspects, right? We are saying that an asset or a liability which would not have otherwise got recognized. A classic example would be a contingent liability. Right? Remember, in Ind As 37, we talked about that contingent liabilities are not measured. They are recognized in the form of disclosures. But the moment we say there is an acquisition accounting, there is a business acquisition or a business combination taking place, we experience instances that even this is recognized at fair value. Okay, we'll be seeing some examples around that. All right. Similarly, while we said that the assets and liabilities are required to be measured at the acquisition date fair value, there are again exceptions to that, very limited exceptions. For example, with respect to income taxes, okay, there could be some employee benefits. So you still bring Ind As 12 here, you bring Ind As 19 recognition and measurement criteria, right? Under Ind As 19, we understand that the liabilities are measured on the basis of present value, especially when these are, categorically when these are long-term liabilities, including defined plans, right? There are some aspects of indemnification assets. We'll be discussing those as well. All aspects of operating leases is also covered. Share-based payments rewards. We briefly talked about that some time ago, so that's a context. Even the assets held for sale are not recognized at the fair value, but at the same criteria as we do it under Ind As 105. And finally, any reacquired rights are also measured in a different way. So there's a treatment done for these as well separately. Okay, so let's try to understand these one by one. We say that, for example, in case there is a contingent liability, very clearly the acquirer recognizes a contingent liability if there is a present obligation. Even though it is not probable that outflow will be required. Okay, the peculiar behavior of or peculiar characteristic of a contingent liability is that there either the present obligation is missing, or even if there's a present obligation, but it is not probable that the future outflow of resources would be required, right? But the moment you say you are acquiring a business, okay, in case there is a present obligation and the fair value can be measured reliably, okay, in case there is a present obligation and the fair value can be measured reliably, the acquirer is required to recognize that contingent liability on the acquisition date. Ind As 37's requirement do not apply in that context, something that you want to remember here, right? Likewise, we say the income taxes, no deferred tax consequences are recorded other than those for the assets or liabilities acquired under the business combination. We just explained that. We just discussed that in detail, and that is something which is a very commonly tested adjustment in the examination, right? So be very comfortable about it when you are looking at that adjustment, right? So simply the acquirer shall account for the tax impact of those temporary differences and the carry forwards, etc., as per Ind As 12. That is something which you're supposed to follow. Okay. If I look at the contingent example, contingent liabilities example, right? All I'm trying to highlight here is that there is a company A that acquired, let's say, company B. Okay. A company B has a court case going on, and while there is a present obligation, future outflow is not expected, right? So in a way, it meets the definition of the contingent liability. Okay. Now, of course, company B is giving an extensive disclosure about that in its financial statements. But the moment this acquisition is being discussed, being talked about, being accounted for, company A assesses that there is a present obligation as far as company B's, contingent liability is concerned, and it ascertains with the help of experts, for example, that the fair value of this so-called as contingent liability can be determined, and whatever that value is, let's say for the sake of a number, we are saying it is 5 crore rupees. Okay. So while doing the accounting for the goodwill, while measuring that goodwill, this contingent liability shall be recognized and of course be measured at this value of 5 crore rupees. That is something which is the exception to that rule, wherein you start talking about even those or even such kind of liabilities which do not exist, for example, in the books of the acquiring, because they do not meet the measurement criteria. But at a group level, even that becomes an exception to follow, right? Let's have a look at some other categories of exceptions. Further, it says that when you refer to indemnification assets, now it could be a case, I think the slide itself is self-explanatory around that. It says that a seller in a business combination may contractually indemnify the acquirer in case there is a possibility of something that can go against the selling company, right? So I may say there's a company A which is acquired by a company B, but the company is, let's say, into pharma. It could be any other business also, doesn't matter, right? So company A is into pharmaceutical business, and they are doing some researches, they are selling some medicines and drugs, etc. And well, it can always happen that one of the customers comes back and sues company A. Now, if company B acquired company A some time ago, then naturally the onus lies back on company B, because company A is a part of company B itself, right? In such a scenario, it is expected that the selling company, the acquiree, which is company A in our example, it may indemnify the other company against the losses above a specified amount, as in the other party, the acquiree will guarantee to the acquirer that the amount that is expected to be paid will not go beyond a point, right? Accordingly, the acquirer can also get an indemnification asset, right? And accordingly, the treatment of that is done at the same time in the books from both ends, right? So there has to be an indemnity available for the acquirer, right? And it would be able to recognize the indemnification asset in case something wrong happens tomorrow, right? That's something which is the thought process which is brought in here. We'll be discussing that with the help of some example as well, right? Briefly, we said it before, the acquirer shall recognize and measure a liability, etc., with respect to the employee benefits arrangements as per the Ind AS 19. So nothing practically changes in that context. If there were continued liabilities in the books of the acquiring, they shall continue in the same manner in the books of the acquirer as well. Okay. Similarly, we talk about intangible assets. Now, importantly, identifiability would be a criteria, right? This is purely this has been discussed completely at length when we discuss Ind AS 38, right? So the identifiability criteria, if it is met there, then naturally the acquirer shall recognize, those intangible assets as well in its own set of books, right? Now, this is something that we covered under the options where we look at the replacement rewards, etc. So that treatment of that is done exactly the same way, as you do it in Ind AS 102. So there's no change in between that. Okay, so this is again not very a detailed conversation or discussion that we want to do about it. Okay, finally, as far as a non-current asset held for sale is concerned, that would be necessarily recognized as per the similar provisions of the standard, right? So effectively what I was saying is, right, Ind AS 19, Ind AS 105, Ind AS 102 we do similar treatment for all these. Okay, the moment I say I'm looking at Ind AS 37, then you bring the contingent liabilities at fair value. That would be one exception. As far as Ind AS 12 is concerned, you again look at the fair value differences, what we just discussed. All right. And then we also talked about, of course, indemnification assets to be recognized. And finally, of course, we talked about the intangible assets, where we had the identifiability criteria being met there. Okay, what we're doing now is, of course, discussing a few examples around these concepts to understand whether we are able to apply those thoughts in the right manner or not. Okay, thank you very much.